Hello, so today we're going to be talking about how to value a growth stock. Now, there are many different ways of valuing a growth stock, and this can often be seen with regards to the fluctuations in the price of a stock, because first of all, obviously you've got speculation on where people think a stock is going to move to, where they think the company's going, are they going to make more profit or less profit this year, and things like that. That kind of affects the price, but also different people's opinions on the valuation of the stock will also impact it. So, for example, if you're using a price to earnings ratio, or if you're using the earnings per share, or like all of the different ways that you can kind of calculate the price and calculate the value for what you personally think is the most effective. And when you've got millions of investors out there looking to buy and sell shares of a company based on different price estimates and different kind of ways of valuing the company, that's why you kind of get such a volatile market and the share price moving up and down so much. Now, that when it comes to growth stocks, that moves to a whole new extreme, because you've no longer got like those fundamental kind of numbers. You basically have to like guess and estimate where the company is going to be in like 5 to 10 years, which means it's really hard to kind of come up with an accurate price. And based on that, this is another reason why you also need to be very careful with your price target compared to the current price of the stock. So, for example, I've got Amazon here, and as you can see on Yahoo Finance here, the market cap for Amazon at the moment is about 1.75 trillion. Now, if you were to go through your calculations and you think, do you know what, I think in a few years' time Amazon's going to be worth $2 trillion, you would not invest in Amazon based on that, because of the fact that Amazon's a growth stock, and that $250 billion is within the margin of error. Now, you might think that sounds completely crazy, like $250 billion cannot be a margin for error. But with Amazon's stock price at the moment, a market cap, if you think that is actually only 1/7 of its current value in movement, which it could quite easily do that in a space of a couple of days. So, well, if you had the price value of 2 trillion for Amazon, it may still be worth investing to an extent. It's not really the kind of thing that a growth investor that would do, and it is quite a high risk trade. You're kind of moving more into the risk of like a day trading element there. If you're calculating Amazon, like I say, to be worth say $2 trillion. Realistically speaking, if you're a growth investor, you should be valuing Amazon. If it's a suitable investment, you should be looking at valuations of 3 trillion or upwards to make it worthwhile. And really, you'd probably want it to be more than that as well. Now we move on to how we actually figure that out. And the way I kind of decide on valuations for a growth stock is I look at its current market cap and I figure out roughly what kind of income the company would need to justify that market cap. So, say for example, we've got Amazon here. To make it easy, I'm going to say let's push it up to a current market cap of 2 trillion. And with that, we would be expecting the net income for Amazon to be $100 billion to make it worth $2 trillion. Okay, so we're talking about a multiple of say 20 times. And like I say, this is all very kind of like rough estimates, because at the end of the day, it may well be that actually to reach that target, Amazon needs $95 billion as net income, or it could be that it needs $150 billion net income, which again, obviously there's quite a big margin for error there. But that's the kind of numbers that we should be looking at and thinking of, where if we were going to invest. So, sorry, let me take it a step back. So, sticking with that, we're looking at around $100 billion net income to be worth a final value of $2 trillion. Now, when you kind of consider that, at the moment, for example, we're looking, Amazon's current earnings are 21 billion. So we're quite a way off of that. With its current market cap, what the market is kind of saying is that they think in 5 to maybe 10 years' time, Amazon should have the potential that they could be making 100 billion in income. Now, obviously, current is a growth stock at the moment, so currently what is happening is a lot of the money is being reinvested back into growth, which comes off of that income number. So when the business is kind of growing so massively and reinvesting in itself, it's not making profits as such, and therefore the net income and the earnings seem a lot lower than they actually are in regards to that. So currently, I mean, like I say, with that current valuation, we're talking about, 1/4 roughly ish of its current revenue as profit to justify that price tag. Now, like I say, what we do is you need to be looking 5 to 10 years out for the company to kind of configure where you think that company's going to be in that period of time. And if you think that in 5 to 10 years' time, well, let's pick with Amazon here. So if I was to say, for example, that in 5 years' time, I think Amazon's income is going to be $100 billion, but in 10 years' time, I think Amazon's income is going to be $500 billion, then we could quite easily say, actually, Amazon stock's worth buying right now, because in 5 years' time, that share price is going to increase by 5 times what it currently is now. Because the way we're kind of looking at it is the market kind of prices the stocks about 5-ish years out. With growth stocks, sometimes it can be a bit further, but it's very variable. You as long as you've got that long-term view of how the kind of company should be worth, how much the company should be worth in the future, you can scale that back, and you know that the market will catch up with that valuation at some point. So really, it's a case of how long you want to hold that stock for. And like I say, with that example, and this is purely an example, I'm not basing this on any analysis of Amazon. I'm not saying that I think Amazon is going to be worth any of this numbers at all. This is just as a point of context. So if we were to say, that Amazon will be worth, or will be generating $500 billion in profit in 10 years' time, then we know that we could buy the shares today, and in 5 years' time, we should be significantly up on our shares, worth roughly at about 5 times what they're currently worth now. And that is how you figure out with growth stock, because you have to do it based off of how you think those earnings are going to be. And it needs to be quite far into the future. You need to be going 5-10 years to figure these numbers out. And you also need to make sure that what you're looking at is continuous growth. You don't want to be holding a growth stock when it starts to peak. Okay, so if let's say Amazon, for example, that it was going to hit in 5 years' time, it was going to hit that total net income of $100 billion. So it's going to reach its current market cap, and then it was going to stop growing. If that's what you kind of estimated, you wouldn't hold this stock now. You wouldn't buy this stock, because even if you think it's going to go up very slightly, there's so much risk that what could happen is the growth trajectory could slow down, And as soon as it starts to slow down, the market panics and the share price drops. And then it may take years to kind of climb back up to the valuation that you're expecting. Whereas when you've got a continuous growth in the stock, you know that you can hold that stock and it should continue to grow with the company over each coming year. Okay, so ideally, even like I've said, we're looking at 10 years out. Ideally, you still want the company to be growing at a good rate even after 10 years. Because if they're going to stop before that 10-year period, they're not necessarily a very good growth stock, because they're going to start to peak and they're going to start to slow down. So I hope that all makes sense. Thanks for watching, and I'll see you in the next video.